Question 1. Which of the following best describes the primary difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance applies only to individual risks, while treaty reinsurance automatically applies to a portfolio of risks under an agreement. B. Facultative reinsurance covers risks that exceed a specific threshold, while treaty reinsurance covers all risks within an insurer's portfolio. C. Facultative reinsurance involves a negotiated contract for a specific risk, while treaty reinsurance is a pre-stamp contract covering all risks of the ceding insurer. D. Facultative reinsurance applies only to catastrophic events, whereas treaty reinsurance is used for all forms of risk. Answer. C. Explanation. Facultative reinsurance is negotiated on a case-by-case basis for specific risks, while treaty reinsurance is a more general agreement that automatically covers a set of risks. Facultative reinsurance allows the ceding insurer to choose which risks to cede, whereas treaty reinsurance involves a standing agreement covering all or a specified category of risks. This distinction is critical in the reinsurance land, especially in managing diverse risk exposures. The regulatory environment in North Carolina does not mandate that facultative reinsurance must cover a specific risk threshold, but rather it emphasizes the nature of risk selection in facultative contracts. Question 2. Mr. Allen, a reinsurance broker, is reviewing a new reinsurance contract between a ceding insurer and a reinsurer. The ceding insurer is required to pay a fixed percentage of the premiums to the reinsurer, while the reinsurer assumes liability for losses above a certain threshold. Which type of reinsurance contract is Mr. Allen reviewing? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Retroactive reinsurance. Answer. B. Explanation. This scenario describes an excessive loss reinsurance contract where the reinsurer is liable for losses exceeding a specified threshold, typically on a per occurrence or aggregate basis. Under this arrangement, the ceding insurer retains responsibility for losses up to the threshold. The reinsurer does not participate in the underlying premiums but covers losses above the retention limit. The North Carolina Department of Insurance requires reinsurance contracts to be clearly defined in terms of liability limits and conditions, which is characteristic of excessive loss agreements. A quota share or surplus share would involve a proportional. The premiums and losses are like the non-proportional excessive loss. Question 3. Scenario. Mr. Bradley, the Chief Risk Officer of a medium-sized insurer in North Carolina, is reviewing a treaty reinsurance agreement for his company's property portfolio. His company is considering a treaty that would require them to cede a percentage of their premiums to a reinsurer in exchange for coverage of a fixed portion of their claims. The treaty stipulates that the reinsurer will only pay for claims that exceed $1 million per event. Given the nature of the treaty and the company's risk appetite, what kind of reinsurance agreement should Mr. Bradley consider? A. Stop-loss reinsurance. B. Surplus share reinsurance. C. Quota share reinsurance. D. Excessive loss reinsurance. Answer. D. Explanation. Mr. Bradley is considering an excessive loss reinsurance agreement as it is defined by its structure of covering claims above a certain threshold. In this case, the $5 million threshold aligns with an excessive loss arrangement where the reinsurer assumes liability only for claims exceeding that amount. Stop-loss reinsurance typically covers aggregate losses exceeding a certain percentage of total premiums, which is from claim-specific thresholds. Surplus share and quota share are proportional forms of reinsurance that do not operate on a threshold-based payment structure and would not be suitable for covering individual claims exceeding a specific amount. North Carolina's reinsurance laws require that such thresholds and conditions be clearly defined in the reinsurance treaty for enforceability and transparency. Question 4. Which of the following is the primary purpose of using reinsurance in the context of capital management? A. To eliminate all potential liabilities associated with the ceding insurer's portfolio. B. To improve the ceding insurer's ability to meet regulatory capital requirements. C. To create more profitable investment opportunities for the ceding insurer. D. To replace traditional underwriting procedures in risk selection. Answer. B. Explanation. The primary purpose of reinsurance in capital management is to improve the ceding insurer's ability to meet regulatory capital requirements. Reinsurers help insurers by reducing the amount of capital required to support their portfolio of risks, effectively enabling them to absorb more risk without violating regulatory solvency standards. This is achieved through the cession of risks to the reinsurer, which may decrease ceding insurers' overall loss exposure and thus reduce its capital requirements. Reinsurance does not eliminate all liabilities, answer A, or replace underwriting, answer D, nor is it intended for creating investment opportunities, answer C, although it may indirectly affect investment strategies. Question 5. Which of the following is the main characteristic of a quota share reinsurance agreement? A. It involves the reinsurer covering a fixed percentage of losses above a retention limit. B. It is a non-proportional agreement where the reinsurer assumes responsibility for catastrophic losses. C. It involves the reinsurer sharing a fixed percentage of both premiums and losses. D. It involves the ceding insurer retaining all risks below a defined threshold and ceding losses above it. Answer C. Explanation. A quota share reinsurance agreement is proportional in nature, where the reinsurer assumes a fixed percentage of both the premiums and losses of the ceding insurer. This means that both parties share the same proportion of premiums and claims, regardless of the amount of the claim. Unlike non-proportional reinsurance agreements such as excessive loss, quota share does not involve a threshold above which the reinsurer is liable. Type of agreement is useful for spreading risk evenly across both parties. Options A, B, and D describe characteristics of other reinsurance types, not quota share. Question 6. Mr. Smith is reviewing a treaty agreement that covers catastrophic events. The reinsurer only covers losses exceeding $10 million, and the ceding insurer retains the first $10 million in losses. Which reinsurance contract best describes this arrangement? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Stop loss reinsurance. Answer B. Explanation. This arrangement describes excessive loss reinsurance, where the reinsurer is liable for losses exceeding a certain threshold, in this case $10 million. The ceding insurer retains the initial $10 million, and the reinsurer assumes responsibility for any additional losses above that amount. Quota share reinsurance involves a proportional sharing of premiums and losses, answer A, while surplus share reinsurance applies surplus risks and typically involves a proportional sharing arrangement, answer C. Stop loss reinsurance covers aggregate losses over a set percentage of the ceding insurer's premiums, which is not the case here, answer D. Question 7. Which of the following best describes the role of a reinsurance broker? A. To provide legal counsel to the ceding insurer regarding reinsurance contracts. B. To negotiate reinsurance contracts between the ceding insurer and the reinsurer. C. To directly underwrite risks on behalf of the ceding insurer. D. To assess and establish the solvency of reinsurers before recommending a partnership. Answer B. Explanation. The role of a reinsurance broker is primarily to negotiate reinsurance contracts between the ceding insurer and the reinsurer. Brokers act as intermediaries who assist the ceding insurer in finding the right reinsurance coverage at competitive terms, while also helping to assess the financial strength of potential reinsurers. They do not underwrite risks directly, answer C, nor are they typically involved in legal counsel, answer A. While brokers might assist with solvency assessments, the responsibility for underwriting and solvency regulation primarily falls to the reinsurer and the ceding insurer, not the broker, answer D. Question 8. Which of the following best describes a retroactive reinsurance contract? A. A reinsurance contract that covers losses on risks occurring in the past, typically for a previous insurer's liabilities. B. A reinsurance agreement that covers catastrophic losses after the initial claim has been paid. C. A reinsurance treaty that applies to ongoing risk exposures over a set period. D. A type of facultative reinsurance applied only to new business underwritten by the ceding insurer. Answer A. Explanation. Retroactive reinsurance covers losses that have already occurred but were not previously covered, often applying to a previous insurer's liabilities. This type of reinsurance typically addresses past claims that were not part of the ceding insurer's original portfolio but are still outstanding. This is distinct from reinsurance treaties that apply to future or ongoing risks. Excessive loss, answer B, and facultative reinsurance. D. Focus on future or specific risk exposures, not past liabilities. Retroactive reinsurance is crucial in managing long-term liabilities and addressing insolvencies or old claims. Question 9. Which of the following best describes the function of the surplus lines in North Carolina's reinsurance market? A. They allow insurers to cede risks that exceed the statutory limits of licensed insurers within the state. B. They refer to policies offered by licensed insurers to cover excess risks outside of state jurisdiction. C. They are used exclusively to cover risks of non-admitted insurers operating in North Carolina. D. They are used to reinsure state government-owned insurance risks only. Answer A. Explanation. Surplus lines in North Carolina refer to the ability of insurers to cede risks that exceed the capacity or statutory limits of licensed insurers in the state. This mechanism allows for the transfer of risks to non-admitted insurers who do not hold a license in the state but are authorized to provide coverage for high-capacity or specialized risks. Surplus lines brokers play a key role in facilitating these arrangements. Options B, C, and D incorrectly describe the scope of surplus lines as they focus on out-of-jurisdiction risks or governmental insurance, which is not the primary use of surplus lines. Question 10. Which of the following is a key factor in determining reinsurance pricing? A. The total number of policyholders covered by the ceding insurer. B. The ceding insurer's current claims history and risk exposure. C. The interest rates on government bonds. D. The reinsurer's geographical location relative to the ceding insurer. Answer B. Explanation. The ceding insurer's current claims history and risk exposure are crucial factors in determining reinsurance pricing. Reinsurers assess the risk associated with a portfolio of risks to establish an appropriate premium to charge for the coverage provided. Other factors include the ceding insurer's loss history, the type of coverage requested, and the overall risk profile of the insured business. Option policyholders and option D geographical location may be relevant in broader risk assessments, but the primary pricing factor remains the actual risk exposure. Option C interest rates can influence the broader financial environment but is not a direct factor in reinsurance pricing. Question 11. Which of the following is the primary advantage of facultative reinsurance over treaty reinsurance? A. Facultative reinsurance provides a blanket agreement for all risks under a treaty. B. Facultative reinsurance allows the ceding insurer to cede individual risks on a case-by-case basis. C. Facultative reinsurance requires less documentation compared to treaty reinsurance. D. Facultative reinsurance is more cost-effective for small insurers compared to treaty reinsurance. Answer B. Explanation. Facultative reinsurance is more flexible compared to treaty reinsurance because it allows the ceding insurer to cede risks on a case-by-case basis. Each individual risk is assessed and covered separately, making it ideal for large or unusual risks that do not fit within the scope of a treaty agreement. On the other hand, treaty reinsurance involves a broader automatic agreement covering a set category of risks without individual review. Facultative reinsurance does not automatically provide blanket coverage, answer A, and typically requires more documentation rather than less, answer C. Question 12. Which reinsurance clause would a ceding insurer typically use to ensure that the reinsurance coverage automatically renews without renegotiation? A. Arbitration clause. B. Reinstatement clause. C. Automatic renewal clause. D. Cancellation clause. Answer C. Explanation. An automatic renewal clause in a reinsurance contract allows the coverage to automatically renew at the end of the contract period without requiring renegotiation unless either party provides notice of cancellation. This clause helps ensure continuity of coverage and simplifies contract management. The arbitration clause, answer A, addresses dispute resolution. The reinstatement clause, answer B, relates to coverage after a loss, and the cancellation clause, answer D, defines the conditions under which the contract can be terminated early. Question 13. Mr. Thomas, an underwriter for a ceding insurer, needs to assess the risk associated with a large industrial complex. Which of the following is the most critical factor in determining the reinsurance pricing for this risk? A. The reinsurance company's overall premium income. B. The geographical location of the insured complex relative to catastrophe zones. C. The risk appetite of the ceding insurer. D. The total value of the industrial complex's assets. Answer B. Explanation. The geographical location of the insured complex is critical in assessing the risk, especially with regard to natural catastrophe risks, e.g. earthquakes, hurricanes, floods. Locations prone to such events require higher reinsurance premiums due to the increased likelihood of catastrophic losses. What asset value and the ceding insurer's risk appetite are important. The location in relation to catastrophe zones has a more significant impact on the pricing of reinsurance. The reinsurance company's income, answer A, is not a primary factor in setting the premium. Question 14. Which of the following is a feature of non-proportional reinsurance? A. The reinsurer assumes a fixed percentage of both premiums and losses. B. The reinsurer's liability is triggered only when losses exceed a certain threshold. C. The reinsurer shares equally in the profits and losses of the underlying insurance business. D. The ceding insurer must obtain approval for each individual risk ceded to the reinsurer. Correct answer. B. Explanation. Non-proportional reinsurance, such as excessive loss, involves the reinsurer's liability being triggered when losses exceed certain threshold. This means that the reinsurer only pays for losses that surpass the agreed-upon retention limit, rather than sharing proportional losses from the start. Proportional reinsurance, answer A, does share fixed percentage of both premiums and losses. Option C is describing proportional or quota share agreement, and option D is more relevant to facultative reinsurance. Question 15. How does the profit commission clause in a reinsurance contract typically work? A. It provides the ceding insurer with a share of the reinsurer's profits based on the total premium income. B. It provides the reinsurer with share of the ceding insurer's profits from the reinsurance arrangement. C. It offers an additional bonus payment to the reinsurer if claims are lower than expected. D. It requires the ceding insurer to pay fee if the claims paid by the reinsurer exceed the premiums ceded. Answer. C. Explanation. A profit commission clause typically offers the reinsurer a bonus payment if the claims paid by the reinsurer are lower than expected, indicating that the reinsurance arrangement has been profitable. This clause incentivizes the reinsurer to manage the risks prudently. Answer. It describes the profit-sharing concept, but not in the context of the reinsurer's profits, while option B describes reverse situation. Option D is more akin to loss carryforward or claims cost clause rather than a profit commission. Question 16. Which of the following is an example of retroactive reinsurance? A. A reinsurance contract that covers losses occurring within the next 12 months. B. A reinsurance arrangement that covers claims from previous underwriting years. C. A reinsurance agreement that automatically renews for the next policy year. D. A reinsurance contract that covers only future catastrophic risks. Answer. B. Explanation. Retroactive reinsurance covers claims or losses that occurred in the past, typically for policies written by an insurer in previous years. This is often used to manage old claims that have not been fully addressed or paid out. Excessive loss, answer D, is typically future-oriented and covers catastrophic risks moving forward. Retroactive reinsurance helps insurers manage liabilities that may otherwise remain unresolved. Question 17. What is the role of surplus share reinsurance? A. The reinsurer shares a fixed percentage of premiums and losses once a retention level is exceeded. B. The reinsurer takes on all losses for the ceding insurer regardless of the amount. C. The ceding insurer retains a portion of each risk and the reinsurer shares the excess. D. The reinsurer only covers catastrophic losses that exceed a threshold. Answer. C. Explanation. In surplus share reinsurance, the ceding insurer retains a portion of each risk and cedes the excess above the retention limit to the reinsurer. The reinsurer assumes responsibility for the amount over the specified retention level. This type of agreement is proportionate, unlike excessive loss, which is non-proportional. Option. It describes quota share. Answer B is incorrect because the reinsurer doesn't assume all losses, and answer D describes excessive loss. Question 18. Which reinsurance mechanism is best suited for managing catastrophic risks? A. Quota share reinsurance. B. Facultative reinsurance. C. Excessive loss reinsurance. D. Stop loss reinsurance. Answer. C. Explanation. Excessive loss reinsurance is best suited for managing catastrophic risks because it covers losses that exceed a predetermined threshold, which is typical for catastrophic events. The reinsurer only pays when the losses surpass the ceding insurer's retention level. This structure is ideal for events such as natural disasters. Quota share and facultative reinsurance are more typically used for general risk sharing and individual risks, respectively. Question 19. What is the main reason a ceding insurer may choose to purchase stop-loss reinsurance, A, to cover specific individual risks that exceed a given limit, B, to protect itself from aggregate losses that exceed a certain percentage of its premium income, C, to automatically renew coverage for all existing risks, D, to negotiate the terms of reinsurance contracts on a case-by-case basis. Answer: B. Explanation. Stop-loss reinsurance is designed to protect the ceding insurer from aggregate losses that exceed a certain percentage of its premium income. It provides a safety net when overall claims are high, which can occur in multiple smaller claims or large-scale losses. Option A describes excessive loss. Option C refers to automatic renewal clauses, and option D is more relevant to facultative reinsurance. Question 20. Which of the following is not typically the responsibility of a reinsurance broker? A. Evaluating the financial stability of potential reinsurers. B. Negotiating and placing reinsurance contracts. C. Managing the underwriting process for individual risks. D. Facilitating communication between the ceding insurer and reinsurer. Answer: C. Explanation. A reinsurance broker does not manage the underwriting process for individual risks. Answer C. The broker acts as an intermediary who helps place the reinsurance contracts and ensures that the ceding insurer finds the best coverage for its needs. Brokers also help assess the financial strength of reinsurers. Answer A. And facilitate communication. Answer D. But they do not directly handle underwriting. Question 21. What is the purpose of the reinstatement clause in reinsurance contracts? A. To automatically renew the coverage for another period. B. To restore the coverage limit after a loss event, usually by paying an additional premium. C. To trigger a new reinsurance agreement when a previous agreement expires. D. To allow for the cancellation of the contract before the term ends. Answer: B. Explanation. The reinstatement clause in reinsurance contracts allows the ceding insurer to restore the coverage limit after a loss event, typically by paying an additional premium. This ensures that the ceding insurer can continue to be covered for future risks even after a large claim has been made. Option A refers to automatic renewal, which is different from reinstatement, and options C and D do not accurately describe the purpose of a reinstatement clause. Question 22. Which of the following describes a quota share reinsurance agreement? A. The reinsurer covers only the portion of losses above the retention level. B. The reinsurer and ceding insurer share premiums and losses in a fixed percentage. C. The reinsurer assumes all risks from the ceding insurer after a set period. D. The reinsurer covers only the catastrophic losses of the ceding insurer. Answer: B. Explanation. In a quota share reinsurance agreement, the reinsurer and the ceding insurer share both premiums and losses in a fixed percentage. This type of proportional reinsurance is used when the ceding insurer wants to spread risk and reduce volatility. Answer: it describes excessive loss reinsurance, while options C and D do not align with the characteristics of quota share. Question 23. Which of the following best describes financial reinsurance? A. Reinsurance used primarily to cover natural disaster risks. B. Reinsurance arrangements designed to improve the ceding insurer's financial position. C. Reinsurance where the reinsurer is exposed to the risk of catastrophic losses. D. A mechanism that helps the ceding insurer pay claims above the retention limit. Answer: B. Explanation. Financial reinsurance is designed primarily to improve the ceding insurer's financial position, often for purposes such as reducing reserves or enhancing solvency ratios. It is more about managing financial outcomes rather than purely covering underwriting risks. This is distinct from other types of reinsurance that focus on managing risk exposure, such as excessive loss, Answer C, or catastrophe reinsurance. Question 24. What is typically the primary objective of a reinsurer when setting reinsurance rates? A. To ensure that the ceding insurer is covered for all of its risks. B. To make a profit while sharing risks with the ceding insurer. C. To increase the premiums paid by the ceding insurer. D. To offer the lowest possible rates to attract new business. Answer: B. Explanation. The primary objective of a reinsurer when setting rates is to make a profit while appropriately sharing the risks with the ceding insurer. Reinsurers need to balance their pricing to cover potential losses while ensuring profitability. Offering the lowest rates may not always align with long-term profitability. Answer D. And ensuring all risks are covered is the ceding insurer's responsibility. Answer A. Question 25. Which type of reinsurance provides coverage for losses that exceed a specific loss limit on a single risk? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Facultative reinsurance. D. Stop loss reinsurance. Answer. B. Explanation. Excessive loss reinsurance provides coverage for losses that exceed a specific threshold or limit, often on a single risk or a group of risks. This is a non-proportional reinsurance arrangement where the reinsurer only pays when the loss exceeds the agreed-upon limit. Quota share. Answer A is proportional. Facultative. Answer C is for individual risk placements. And stop loss. Answer D is for aggregate losses. Question 26. Which of the following reinsurance arrangements automatically applies to all risks within a certain class without individual underwriting? A. Facultative reinsurance. B. Excessive loss reinsurance. C. Treaty reinsurance. D. Surplus share reinsurance. Answer. C. Explanation. Treaty reinsurance automatically applies to all risks within a certain class or type of business, and it does not require individual underwriting or negotiation for each risk. This provides broad, automatic coverage for the ceding insurer. Facultative reinsurance, answer A, requires individual assessment, while excessive loss, answer B, and surplus share, answer D, involves specific types of risk management. Question 27. What does a cession refer to in a reinsurance contract? A. The amount of premium paid to the reinsurer. B. The process of transferring risk from the ceding insurer to the reinsurer. C. The reinsurance agreement covering a specific risk. D. The limit at which the reinsurer's liability is triggered. Answer. B. Explanation. Cession refers to the process of transferring risk from the ceding insurer to the reinsurer. The ceding insurer cedes or transfers a portion of the risk to the reinsurer, who assumes responsibility for the agreed-upon portion. This process is fundamental to the structure of reinsurance agreements. Option A refers to premiums, option C is more about specific agreements, and option D describes retention limits. Question 20. Which type of reinsurance arrangement is most likely to be used when the ceding insurer is trying to limit its exposure to particularly high or unpredictable losses? A. Stop loss reinsurance. B. Quota share reinsurance. C. Facultative reinsurance. D. Excessive loss reinsurance. Answer. D. Explanation. Excessive loss reinsurance is most commonly used to limit exposure to particularly high or unpredictable losses, often in the case of catastrophes or large individual claims. It protects the ceding insurer from losses that exceed a specified limit. Stop loss, answer A, covers aggregate losses, while quota share, answer B, shares proportional risks, and facultative, answer C, covers individual risks rather than providing protection. Question 29. How does reinsurance pricing typically affect the ceding insurer's underwriting? A. Reinsurance pricing is not directly linked to underwriting decisions. B. High reinsurance pricing encourages insurers to take on riskier policies. C. Reinsurance pricing helps to balance the risk pool and stabilize underwriting results. D. Low reinsurance pricing automatically improves underwriting profitability. Answer. C. Explanation. Reinsurance pricing is closely tied to underwriting decisions because it helps balance the risk pool and stabilize underwriting results by spreading risk. Insurers use reinsurance to protect against large or catastrophic losses, making pricing a crucial element in their overall risk management strategy. High reinsurance pricing may deter riskier policies, answer B, and low pricing doesn't guarantee profitability. B. Question 30. In a proportional reinsurance agreement, which of the following is true about the reinsurer's responsibilities? A. The reinsurer only covers losses exceeding specific limit. B. The reinsurer assumes fixed percentage of both premiums and losses. C. The reinsurer provides coverage only for claims that exceed the ceding insurer's retention. D. The reinsurer pays lump sum to the ceding insurer in case of loss. Answer. B. Explanation. In proportional reinsurance, like quota share, the reinsurer assumes a fixed percentage of both premiums and losses. This means the reinsurer shares a proportional part of both the premiums collected and the claims incurred. This arrangement helps distribute risk more evenly between the ceding insurer and the reinsurer. The other options describe non-proportional arrangements.